First rates on your screen, and there you go. Apollo Tyre, a block deal, GTL Infra, Yes Bank, Reliance Power, lot of green. I can only see on my screen if I have to really look at the market right now. Devyani International, newsmaker. Let's look at the market reaction to Devyani International first thing. 8.5% higher for Devyani International. We are in a bull market where if you're acquiring growth, markets would say thank you. You're in a bear market. When you make acquisitions, markets would say OMG, why are you acquiring? So it's a bull market, it's evident. 193 rupees. You got HDFC Bank, which is not going anywhere. If FIs are back, they are not buying HDFC Bank, that I can tell you. They were supposed to buy HDFC Bank. Shipping Corporation, G Shipping. A little bit of trouble in Red Sea, and shipping stocks yesterday were in demand, and today they are looking okay. Then you've got, in terms of the volume, I just want to look at where is the volume. It's Apollo Tyre because of block deal. It's Reliance Industries. And then a surprise mover, I guess, today is Dixon Technologies, which is trending up on very nice volumes. And Zomato has gone right up to 130 rupees now.
Yeah, CLSA has maintained their outperform on Dixon. They the target price also now to 7,070 as well from the earlier 56.75. So a sizable upgrade coming in on Dixon, 2.5% higher for Dixon as we speak right now. Devyani, of course, is perking up quite nicely, about a 4.5% uptick on that stock. There's IDFC as well, so look out for that. IDFC Bank, they received no objection from the RBI for the amalgamation with the Holdco, 1.6% higher for that stock. There's ONGC RIL, the windfall tax on crude has been reduced, although you're not seeing a material move, at least on Reliance Industries. Vedanta, that's the one, buzzing stock of late. Yesterday as well was a mover. Now they've announced that dividend of 11 rupees per share as well, so look out for that. There's Sun Pharma, after that 16.7% acquisition for one of the US-based therapeutics company. Look out for that too. NHPC, which is looking to consider a power plant monetization to fund their capex. NHPC in focus as well. There's IRCON. They've got 103 crore rupee order. There's Alcargo Logistics. They've acquired a 51% in one of the companies in Middle East for approximately about 15 odd crore rupees. A small acquisition though. There's JTL too. They've approved a preferential allotment. They're looking to raise funds by QIP, 1300 odd crore rupees. So those are a couple of companies in focus. There's India Glycols, 1164 crore rupee ethanol supply tender for sugar season. That's what they've bagged. 9.5% is the up move that you're seeing for India Glycols. That's a big buzzer this morning. There's of course Apollo Tyres, like Nikunj just flagged off, OMCs. But I also want to revisit some of the movers from yesterday. Let's see what IRCTC is up to, what Hindustan Copper has been doing, what Hindalco is doing, considering the tilt yesterday was towards the metals pack. And today also some of these names hold out, although you're not seeing a follow through on IRCTC for sure. What's Indiabulls Housing up to, and then what Siemens and Zydus Life also up to. Those stocks will just come up for you on your screens. Indiabulls Housing flat with a marginal positive bias. Zydus Life, Zydus Life higher by 0.5%, and Siemens as well will just come up for you on your screens. That's down about 0.7 as we speak right now. But it's just such a flat index today. Kunal, any stock-specific trades that you're looking at?
So I'll still, look at Reliance Industries, even at current levels of 25, 35, 40 on the spot levels. I think it's an attractive breakout for the stock in the last 4 or 5 days. Momentum has also been a bit more higher than the usual normal for Reliance Industries.
Right, Naresh, what are the first trades that you're punching in?
So that would be a buy on Motilal Oswal, which I expect to break out above the 1270 mark in the short term. So at 1220, 1240 looks like a good entry price.
Those are some of the first trades this morning, and looking at the screen, I bet no complaints, 21,433 holding. And as we head into the next year, let's hear it out from Sailesh Ban of Nippon India Mutual Fund. He shares his outlook for the year ahead and stocks and sectors that he's bullish on.
I think the macro conditions have significantly improved, right? And policy continuity is also being anticipated by the market. So I think, and in addition to, the shift in oil prices and things like that, making things look good for India. The challenge is more in terms of the short-term expectations generally running way higher than what the reality is, because earnings need to still catch up. The core earnings need to start becoming more secular from here, and that is what will determine returns. Specific spaces do look attractive. The large cap space is very sensibly priced, but some other pockets are clearly pricing in everything going right for us. So I think 2024 looks good, but I think specifically for large cap space looks much better place there.
So, Sailesh, in this market, we currently have foreign institutional investors and they have got hit because of this millennial term, FOMO. For the year, foreign institutional investors are still net sellers, while domestic institutional investors were big buyers. If one assumes that the SWIFT flows will continue for 2024, so DIs will continue to buy, but FIs will come back. So what could be the scenario in 2024 where suddenly DIs do not want to sell because they've got SIP flows and foreign institutional investors want to come back because they are underweight?
So the foreign investor position has remained fairly underweight because of what's happened in their economies and reallocation to emerging markets through various, either indices or directly. Also, India has done exceedingly well, which allowed a lot of foreign investors to take profit away also in the last 12-18 months. The important thing now is from a geopolitical point of view, from a broader core economy performance point of view, India is doing relatively much better than most other places. So this will be the place where you will certainly find foreign flows gaining momentum. To your question, whether flows from domestic markets will continue and determine the trend later, I think even if flows continue, the reality is we will have to be conscious of right valuations or kind of constraint which valuations always put in. Though the expectations of growth remain to be positive, I think we are already pricing in some pockets of the market, especially the smaller cap businesses. We are virtually pricing in a very large amount of growth and longer term kind of growth horizons and strong growth over a longer period of time.
So, Sailesh, small cap index that has given a return of 40%, and small cap schemes and at least across the board mutual funds have given similar kind of returns in the small cap funds. What should be a very basic approach for small cap stocks for investors and even for SIP buyers in small cap funds?
So you've seen the strong returns which have come, right? This only by itself makes that segment a little more pricier. And clearly, we are finding meaningful, I would say, euphoric activity and sentiment in, say, below 5,000 crore, below 8,000 crore market cap companies, even within the small cap space, right? I think investors can choose to reallocate based on, what ownerships they have in the small cap segment because...
All right, now, this is source based. Z notice to NSE and BSE is acknowledging that they will not be able to meet the 21st December deadline. What is this about? They were supposed to, Z notice triggers existential contract provision in the deal. Now, as per the contract, they were supposed, the Z and the Sony merger was supposed to go through till 21st of December. Over the weekend, Z requested Sony for an extension. What we've been reporting, now this is complete source-based information.
No, Nikunj, this is Sony Pictures' statement.
Okay.
They've issued a press release, so
They've
it's
issued a
not
press
source-based at all. Yeah.
Okay, all right, it's come out.
That's
all right.
their notice. Yeah.
Okay, it's come out to exchange. So Z notice to NSE BSE is acknowledging that they will not be able to meet the 21st December deadline. Now, what is the importance of this? This essentially means that right now, when it comes to Sony and the Z merger, it is stalemate. When the merger was announced, conditions were different, and the merger, for a variety of factors, regulatory scrutiny, NCLTA problems, it's not gone through. What we've reported, and Ankur Mishra has been on top of the story, my colleague, we've been reporting that Sony is now demanding that instead of Puneet Goenka, there needs to be he should not be continued as the CEO of the merged entity. And there has been no consensus, which in a sense looks like the Sony and the Z group have arrived at. And as a result, they will not be able to read the deadline. Now let's look at more picture. Let's look at more details. SPIN is required to start those conversations but has not yet agreed. Z notice, I'll need the press release, I guess, because the flashes are just changing too
I'll
fast.
just read out what we have as of now, and this is Sony's statement. They're saying that Z's notice has triggered existing contractual provision in the deal that allows for both parties to discuss the possibility of extending the deadline. So, Nikunj, I don't think it's categorically that the merger is off the table, but they want timeline definitely to be extended. They're saying Z's notice to BSE NSE is acknowledgement that they will not be able to meet the December 21st deadline. Now, I mean, kind of saying heads you win, or that kind of a scenario almost. So while they're saying that December 21st deadline is not going to be met, they're saying that's pretty close to the SPNI Z merger date. They're saying Z notice triggers existing contractual provision in deal that allows for both parties to discuss the possibility of extending the deadline. So there is some scope, at least, if both the parties do agree to actually extend the deadline there. They're saying SPNI is required to start those conversations, but has not yet agreed to a deadline extension. I guess this is still pretty much work in progress. And they're saying that SPNI is required to start those conversations, like I just mentioned. So that's pretty much it. You are seeing, of course, Z fall down by a good 3% right now. So
Aisha,
it seems like a bit of a limbo there.
So Aisha, as per the deadline, they had to announce.
Yeah.
Now they are looking at extending the deadline. So the first thing is that you have to inform the exchanges that, look guys, the deadline's not been met, and we are not been able to come to a consensus before 21st of December. That's part one. Part two, the merger is not off. If the merger would have been off, then they would have announced to the exchanges that, look, the merger is not going through, which means that there could be an extension to the deadline, and if that happens, as per the listing and regulatory compliance, they will have to inform the exchanges that, look, we are extending the deadline. And looks like the negotiation on who would be heading the merged entity, whether it's going to be somebody from Sony or with Mr. Goenka will continue, which was part of the original deal, looks like there is no consensus per se that has reached. Now, from a market standpoint, it means that next 2 days, nothing is going to happen. The entire merger process could get delayed, but it is not off the table, to keep it very simple. So I think it will have a knee-jerk reaction, and let's see where the stock settles. I don't think the stock is going to correct significantly or crash, because this means that the merger has got extended. See, the market conditions have changed. The world has changed. The landscape in terms of competitive terrain has changed. A lot of mergers globally and locally have happened after that. So what was announced, let's say 24 months ago versus now, the world has changed. So obviously renegotiations actually have clearly started on that front. There you see, thought as much. It's going to be a skim from the top, more like a 3% cut. The V hand-on hard traders, they must have sold out. Z has been moving in and out of FNO, but looks like now that markets are looking at the fine print and saying that the merger is not off. So hopefully it's not like a cancelled deal per se. Meanwhile, markets, they're looking okay. They're holding on. The breath is looking decent. Sony and the Z news, I think, is something which needs to be digested. And it only appears that the deadline will not be met. Another deadline could come. The merger is not off the table. That's what I understand.
Yes, indeed. That's the latest with respect to Z Entertainment, and we will continue to keep you updated as and when we get more details. That's the statement coming from Sony. Moving right on then, interesting conversations that we've been having on the channel, and to talk a little bit about the real estate space, who better than Abhishek Lodha, the CEO of Lodha Group. It was a special interaction with Nikunj. He spoke about his guidance on pre-sales, top-line growth targets, as well as volume growth and much more. Listen in.
We are of the view that we can, keeping our balance sheet very, very conservative, we can grow at 20%, our pre-sales and top line at 20% and deliver 20% ROE. I think if our internal cash flow generations are that strong that we can sustain our 20% growth, then there is no reason for us to add on risk.
Now you guided for pre-sales, and 2 quarters, you've achieved 48% of that. The second half, this time we've had Diwali Dussehra, and the second half traditionally is a better half. So can I safely assume that if I put data point, you're on course not only to meet your guidance, but to beat your guidance?
I would say is that, the 20% growth that we promised last year, we of course promised it taking into account, what we felt the year was going to be like, and it looks like the year is on track to meet that guidance.
Is there a volume growth advantage which you have in that 20%?
Yes, of course. Like I said, we like to keep price growth modest, not low and not very high. We like to keep price growth a little below wage growth. So this year, wage growth in the country is going to be around 9%. We are targeting price growth of between 6 to 8%, and therefore the rest of it is all going to be volume. So we are growing our volumes by about 13-14% this year, partly from existing locations and partly from new locations.
Now, I'm going to ask a question perhaps on behalf of our viewers and your shareholders. Everyone has a different time frame when they're investing in a company. So in 3 years, what they should expect from you, in 5 years, what they should expect from you, and beyond that, I think we'll discuss the next time.
No, I think short term, medium term, which is the 3 and 5 year sort of timelines that you mentioned. I think what you can expect from us is predictable, low risk, 20% growth in our top line and 20% ROE.
That you can do on this large base also.
Yes.
And keeping the debt to equity under 1.
Means our ceiling that we've set for ourselves is 0.5 times.
All right, that's the view coming in from Macrotech developers or Lodha. Let's move right on then, and Dalal Street clearly on a tear. But the question is what the year ahead brings for us. Is this rally going to sustain? Most market veterans believe so. Let's hear it out from some of the top voices. Madhukela, Hiren Ved, Safir Anand, Tahir Badshah and more.
Markets are expensive, there is no doubt about it, from a 12-month perspective. But there are investors who are willing to pay, let's say, take 3 or 4 year view, specifically even the foreign investors who are willing to take 3-4 year view. If I couple that with the certainty of growth in India, right? So then market doesn't look that frothy or that expensive if I take a 3-4 year view. I feel that large caps will also do well here from here on, because if the money comes, which it will, even from the foreigner, given the sentiment and given the overall stability, then the first round of money will come in large cap.
While the small and mid caps in general and the broader markets have done phenomenally well over the last 6-9 months, I think the large caps in general have lagged. And so I think investors want to participate. It's in my view that elephants will dance. So I think there is still an opportunity in the large caps. Not to say that there is no opportunity in the small to mid caps, but I think in a bull market, there's always sector and market cap rotation.
I think large caps will do well, because it is easy for new investors, particularly foreign investors, who are looking at India seriously, not only because India is doing well, but because they are getting bugged out of shape in China. The larger cap financials is the easiest to buy. They're also a large part of the index. So even if these guys underweight, overweight, they still have to put, if not 30% then 25%, but all that has to go into the same large cap names. And within those 3 groups, which is financials, consumer and IT, it is easiest to buy financials because they are doing well and the stock prices have not done well.
General fact that the retailers are making money across all segments. They're not limited only to equity. Gold is doing exceptionally well. Bitcoins are doing fine. Irrespective, housing is doing very well. So generally, there is wealth creation across sectors, which will generally cause greater interest in asset classes, of which equity will also be a part, because you could have a diversified portfolio. The next is the return of FIs, and I think that is going to be a big catalyst for the market. Many people make a statement that the retail is the only element in the market that matters. Retail has caused us to reach where we are. FIs will cause us to move ahead from where we are, because they will now, there's likely to be participation, particularly in the large cap names.
Okay, let's move on, and now let's discuss what are the newsmakers, where is the market headed, and what are the company fundamentals like. And let's now discuss and throw light on what is the prospect of Titagarh Railways going forward. Let's just welcome on board the management as well. Just so much happening within that sector. We have with us Umesh Chowdhary, the Vice Chairman and MD of Titagarh Rail Systems, joining in on the show right now. Umesh, hi. Thanks so much for taking the time out and joining in today on ET Now Morning. Firstly, let me first talk about the recent QIP, the fundraise of 700 crore rupees where marquee investors have participated. How is it that you're planning to utilize and deploy these funds?
Very good morning. Always a pleasure being with you. Yeah, there is a lot happening in this sector, and the whole infrastructure story in India is, I believe, just about beginning. And coupled with that, the Make in India and Atmanirbhar Bharat policies of the government have really been a big booster for industries like us, manufacturing industries who are in the infrastructure space like us. And we are directly, a result of or whatever we are being able to do is directly a result of that. In terms of the QIP, we're very honored, very humbled. We have received a very good response from, as you said, extremely the markiest of the marquee investors. And the purposes of the fund utilization have already been announced. Part of it is to repay debt, part of it is for the long-term working capital, etc. And we are also, as not only for the QIP, but as an overall growth plan, we are now setting up additional lines to manufacture the Vande Bharat coach, which will, of course, require substantial capex. We signed the agreement with ABB, the cooperation agreement, the strategic partnership agreement, where we are setting up the entire propulsion and the TCMS manufacturing. So a lot happening in the sector, as you very rightly summed it up.
So in terms of your total fund requirement for the capex post the QIP, can I say that you don't need capital for next 2-3 years?
Yeah. So as far as the current plans are concerned, whether it's the Vande Bharat, whether it's the ongoing projects that we have, we believe that for both the capex and the working capital, apart from the debt that will need to be taken for both, to some extent, the working capital, etc., that we should be well funded at least for the next 2-3 years. And of course, but what I would like to put the caveat that is for what we are doing now, what we have in the visibility now, but the government or the country is moving so fast. 1 year ago, we did not know that Vande Bharat would be such a great opportunity. 1 year ago, we did not know that wheels will be produced in India. 1 year ago, we did not know that freight targets would be, or 2 years ago, we did not know that freight targets would be set to 3 billion tons. So, of course, we need to keep pace with the kind of speed that the Honorable Prime Minister and the government is taking the country forward with. So, I can only speak at this point of time where we are today, what we have planned today. We should be well funded, as we are also generating cash from our existing operations.
So how is it that you're trying to cash in on this, boom in opportunity, if one can call it that? Because recently also the Railways has floated that tender for the procurement of those 20,000, new wagons. I guess the delivery is slated between July 24th to December 25th. And then, like you're saying, Vande Bharat is a sizable opportunity as well. What is the status on the contracts that you have bid for or tenders in the pipeline that you're working with?
So, as I mentioned that there are opportunities, and it's very important that companies at such junctures are careful of doing what they do. And as far as we are concerned, we have an order book pipeline which we already have for almost about 2.5 years for the freight wagon side. So the tenders of the 20,000 or the additional 10,000, or as we hear from newspaper reports, there is going to be additional tenders coming out very soon. So all of that we are bidding on the basis of our available capacity, so that we don't want to overcommit and underdeliver. That also comes with its own financial consequences apart from reputational consequences. So it's like opportunities right now are like buses on a bus stop. Every 5 minutes there's another one coming in. So which one do we get into without injuring ourselves is what we have to choose.
With so many buses is that lead to traffic jam, and traffic jam in your terminology is competition, right? I spoke to one of your peers yesterday and they said, look, we are looking at expanding in the high-end wagon category. You are doing the same. Isn't there going to be like competition? Because if the pie is so large, even global players could come in now.
So competition is not a bad thing always. Competition is a good thing. It keeps people on their toes. And, as you said yourself, you answered the question, actually, the pie is so large because everybody has a share of the pie. And I believe that what we are looking at is being most cost effective, most competitive. So, we are not today, or we never will be in a monopolistic industry, nor do we want to be. So competition is there and competition will remain there. And as long as we can stay ahead of the curve in terms of keeping our own competitiveness, we don't care about it.
Is the pattern in government payment and orders? There was a time when the government orders were, in a sense, not very popular with corporate sector because there was endless delay in terms of payment and receivables. Has that situation improved?
That actually is the situation that was there more on EPC contracts. We are not in EPC business at all. We are into supply contracts, and our procurements, touch wood, for the last 26 years that I've been in this business, the railways are a very responsible buyer. They are a very efficient buyer. We've not had delays in payments. I'm not talking about a few days on quarter ends or year ends, etc. That's a normal thing that happens in industry or in commerce. But on a larger basis, our industry, where even our price variation formula, you don't need to kind of involve any mind into it. It's the SAP can actually calculate it. So everything is very well defined, what I'm trying to say. There is no ambiguity in the contracts. There is no kind of negotiations that need to be done for settling invoices. That's where I understand. And I don't know too much about the EPC business, so I'm just saying based on my understanding, that's where the delays actually happen. It's not something which is in our industry.
Yours is what structured against LC, which is that as you deliver, you get advance and then you get the full payment. Is that how structuring is done?
We have from the railway contracts an option for LC, but even if we do not take the LC because that entails costs, the payments happen after delivery in a certain number of days.
Umesh, what's the risk to your business? And you were talking about the frequency of buses coming in at the stop. Could this really slow down with the upcoming elections, for instance?
I'm not a crystal ball gazer, but I think India as a story is I believe in the Newton's law of motion. Everything in the state of motion will continue to be in motion. So I don't see that happening in India, because I believe India's time has come. India is and the way the situations are, for my sector, for the railway sector, India, in order to become a 5 trillion, 10 trillion, $30 trillion economy, the logistics cost has to come down from the current 14% to 9%. And that cannot come out by magic. It has to come out by efforts. And that effort is basically moving the road and air to rail and water. So I don't see that there should be a challenge. On the passenger side, people are continuing to travel. We see the kind of congestions that are there in the airports. Ticket prices have soared. So if there is a viable, comfortable, safe alternate available, even a person like me would love to travel by the new Vande Bharat that we are now building. So in June 25, when we launch the Vande Bharat, we would really be happy if the people ditch aircraft or air travel to go by Vande Bharat. So I think that the infrastructure story, the aspirations of the young India is so large that the sector that we don't see that should get impacted.
And I just wanted to get in a sense as well from you on your margin picture, because last quarter they swelled up to about 2.3%, and that was largely aided by the operating leverage. What is the outlook in terms of your margins? Do you think that given there is a lot of intense competition, that perhaps it could continue to remain at these levels?
So we operate in two business segments, the freight and the passenger. On the freight, the normalized margin is about 11-12%. The margins can differ on a quarter-to-quarter basis, and that's really not a very strong benchmark, because when you deliver a certain set of contracts, which may be to a certain set of customers, the margins might be higher than that. But on a blended basis over, let's say, 4, 6, 8 quarters, the margins in the freight business, with the kind of operating leverage that we have been able to achieve, should be in the vicinity of about 12%. A couple of points here or there. Not percentage, but just decimal points here or there. In terms of the passenger business, we are just about starting. We've just again sealed off. We still have not hit the runway to kind of take off. We're doing about 3-4 coaches per month right now, which we are delivering the Pune Metro. Then we will be having the Bangalore with through CRRC, then the Surat and Ahmedabad, then the Vande Bharat. The capacity that we are planning is to get up to 72 coaches a month. So obviously, that's when we reach that, then we can talk about operating leverages kicking in, and also the TCMS and the propulsion business that we are going to backward integrate with. So that's a business that typically should give us a slightly better margin once we have completed the entire picture. But that's going to take a couple of years.
You are in railway business and you're talking about bus. Now you're talking about airlines and taxi and runway. Are you looking at diversification? Should I be aware of something?
That's competition for me, not competitors.
We'd love to actually not fly to somewhere, given the kind of prices and how chaotic airports have become. And next time try Vande Bharat.
Actually, the experience of Vande Bharat and even stations.
Yeah.
I mean, it's just becoming
dramatically different than what it used to be. Yeah.
It's all like, it's like a cycle which has changed completely. So now you don't have to really run on the platform, remember the DDLJ platforms? Those days are gone, at least in our lives now. I mean, they are real, sober, nice, swanky platforms.
There's a downside to everything, and you don't have the DDLJ experience now.
But I guess you have the Insta-worthy moments now, so that's more than making up. All right, good to have you on board. Thank you so much for giving us a better insight into the business and how things are shaping up. That's the word coming in from Titagarh. Tell you what, we'll slip into a quick break. Be right back with the management of Tata Tech. Don't go anywhere. Let's get straight to it. As promised, we've got Warren Harris. He's the CEO and MD at Tata Technologies here to talk business. Thank you so much for taking time out. The best listing, without a doubt, for the year 2023. It's been an over 160% gains on the listing day itself, and so far holding on to some of those gains. But I think the question is, Warren, what the year ahead holds in store for shareholders, and what is it that you would like to share?
Thanks very much for the interest in our company, and thank you very much for the recognition. We're excited about how 2023 has gone and the momentum that we continue to build upon. I think as we move into 2024, there is a little bit of caution that is starting to permeate the sectors that we are operating in, and specifically automotive. But because of the existential challenge that most of our customers are grappling with as the industry transitions from a predominantly internal combustion engine focus to the move to alternative propulsion systems and electrification, and the move to connected services, we continue to expect investment to be strong, and we think that will signal significant tailwinds and demand that we expect to intersect with.
Directionally speaking, would 2024 be better, worse, or more of the same?
I think right now, based upon what we've seen towards the end of the calendar year, I think there's a little bit more caution as we enter into 2024. But I think we'll have full visibility in the sort of February, March timeframe. So as of right now, I would say, more of the same, although the sentiment is starting to decline a little bit, and we'll be able to quantify that, I think, in the early part of what will be our fiscal Q4.
Now, you had earlier indicated that the concerns around VinFast, your Vietnamese client, might impact growth for a quarter. What is the update on that client?
The situation in Vietnam is very consistent with what we see in terms of the life cycle of many new energy vehicle companies. They invest in product, and then they pivot towards building recognition for the brand and building and selling product. We expect that to play out at VinFast. But I would say that they are investing in additional manufacturing capacity here in the United States, and we certainly expect that to be the catalyst for future investment in new products as we enter the new calendar year. So we see a downturn in the next couple of quarters, but we expect that to improve as we move through the calendar year 2024. Outside of that, the traditional OEMs continue to be relatively consistent and predictable. We've been very deliberate in terms of the customers that we target and work with. And so we don't see any structural change or shift to the momentum that we've established. We are very bullish on this space.
And I'm sure you appreciate me saying this, but analysts have suggested recently that KPIT Tech has been bagging more market share due to the higher order win rate. Would you concur? Is that a concern?
The one thing that I would say is that I've got a great deal of respect for KPIT and certainly the leadership team. And they've done great things, I think, to really legitimize the Indian ER&D space and their growth and the type of business that they've won in the recent past. Certainly something that we have studied and followed. But their value proposition is fundamentally different than ours. One of the things that distinguishes Tata Technologies is our ability to be able to develop a complete product. You referenced VinFast before. We've developed 2 electric vehicles for VinFast, an entire electrical architecture for the 4 vehicles that they are launching at the moment. We've done all of their connected services, all of their over-the-air services. And so it's the end-to-end proposition that we represent, whereas companies like KPIT and Alexi are far more focused upon a discrete component of the product development value chains, and specifically software and embedded electronics. So, we benchmark KPIT and Alexi and others, but our value proposition brings us to the competition really with the European and the North American ESPs.
Right. One of the reasons for going IPO was to improve employee retention, right? What's your hiring outlook then for 2024 and the likely onshore-offshore split?
We've made a big investment in our campus recruiting capabilities. We've stood up an internal university, Tech Varsity, that leverages the e-learning platform that we are responsible for. We have an e-learning platform, myigetit.com. 50,000 engineers subscribe to that platform around the world. And not only do we sell it in a B2C context, we also sell it to companies like Tesla and SpaceX and Boeing and Stellantis. So we're very proud of that platform, and it provides us with a major source of advantage as it pertains to the development of talent inside of our organization. You referenced the onshore-offshore ratios. We continue to move up our contribution of services from offshore. We're not an India out company. We are a very balanced global company, and so that onshore-offshore balance is very important to us. But we do believe that the 50-50 ratios that we support today will likely increase in the next 3 years, to somewhere close to about 65-35, and we expect that to make a corresponding contribution to the margins that the company currently support.
Now, 2023, the biggest word was Gen AI. How do you see this scaling up in 2024? What is the other trend for 2024, according to you?
And several of our customers have benefited from the platforms and the applications that we've built around AI. One particular example of that in the smart manufacturing space is the work that we've done to analyze the composition of steel before parts are cast in the foundry, and through the work that we've done in that area, we've really improved or brought down the rejection rates in the cast part area. So we've been leveraging the technology for some time. I think that as far as the move to generative AI is concerned, I think we are anticipating that there's going to be more opportunity for us to be able to develop applications and capability in the generative design and generative product development space. And we're investing not only ourselves, but with our partners, Dassault Systems and Siemens and PTC, to build the POCs that hopefully will give our customer base the confidence that this is not just a technology that is the same as this sort of incremental improvement that we've seen in our industry in the last 10, 20, 30 years. This is a fundamental shift.
Appreciate your time. Thank you for joining in and giving us a view on how business is shaping up and what's next for Tata Tech. Time for a very quick break then, right here on the show. Don't go anywhere. We'll be right back as we've got the management of Fusion Microfinance joining in.
It is the perfect bachelor pad.
तो कब लेना है आपको?
अरे पहले बैचलर तो बन जाने दीजिए। डिवोर्स की फाइल घूम रही है कोर्ट में, कुछ साल लगेंगे अभी।
इसलिए housing.com का हाउसिंग असिस्ट फॉर रेडी प्राइस मैच एंड वेरीफाइड बायर्स। housing.com, पोस्ट योर प्रॉपर्टी नाउ।
Thanks for staying on with us. A quick check-in as to what the market is up to, and consolidation. Well, it looks like that's the name of the game today as well. We're off, but very mildly. So no major cuts for the frontline indices. Names like Z Entertainment, Bandhan Bank, Jindal Stainless, JK Tires, those are under a bit of pressure in trade, while BEML, Century Ply, and even Delta Corp, by the way, is knocking on the door of 150. Those are some of the movers on the upside. But as promised, we've got Devesh Sachdev. He is the MD and CEO at Fusion Microfinance, now joining us. Good to have you on board. Thanks so much for taking time out. Now, recently we had Warburg Pincus, which almost divested about a 10% stake in the company. With this stake sale, what does the stake now come to, and any indications of further stake sales?
Thank you very much and good morning. So I want to just first share with you what were the big outcomes we wanted out of this block deal. One was that we're very clear about the quality of the book. We wanted to bring very high quality investors. Liquidity was one. The existing investors was one goal. We want to expand our overall investor base. We wanted to do anywhere between 10 to 16, 15% of their holding, and we were able to do around 16%. I can also tell you that the overall demand was for 1,200 crore, and we wanted to put around 500 crore. Finally, we did 575 crore. So I think all those boxes have been ticked. Coming to the fact that both Creation entered our cap table in 2016, Warburg in 2018. After this sale, they still hold together around 52%. And they are long-term patient investors. I can tell you very, very clearly that there is no plan to do any other block deal in the near future.
I understand that. But if you're raising capital, ultimately, this is growth capital, I would imagine. And you are looking at scaling up at a time when, in general, markets are worried about microfinance exposure in books, and when unsecured category is a category where Reserve Bank of India has raised a red flag. So are you looking at expanding really at the wrong time?
So Nikunj, one, this is a block deal. The money has not come in the company. That is one. Now, coming to your point on the unsecured book, where the risk weightage has been increased. So I think I have 2-3 quick points here. So one, I think microfinance is not, has been excluded, including the housing and the MSME. That is one. The second is we have to appreciate the regulator for being very proactive. The data speaks for itself. The overall, the book under 50,000 or the small ticket loan has increased more than other asset class. I think overall it was growing around 14-15% more than other asset class. Second, Nikunj, I think one important thing was that there are a lot of platforms where they were building this book and sourcing these customers, but the overall the risk was lying on the bank's balance sheet. So I think in that perspective, it will really help in cooling off some of this, and regulator has been really proactive. As far as microfinance is concerned, look, as I told you, it is not, it is excluded. We have been very, very calibrated, Nikunj. If you see even this year, we will be growing anywhere between 23 to 25%. So we have been very calibrated. There is no other. I think that we do not see any risk right now in the sector. Overall, there was a temporary impact of floods in North India, and which now we have navigated well. So I don't see any, because one, you have to appreciate that this is money which is going for mostly for productive purposes and to the bottom of the pyramid.
Given that you're talking about these growth projections, I just want to understand what exactly is going to drive the growth for the company. If you can just walk us through some of the key triggers.
Yeah. So one is that we are very, very, very diversified. We are present in 22 states. We have now close to 1,200 branches. We have close to 3.73 million customers. So, and then if you see our average outstanding with the customer is still very small. It's 26,000. So I think the growth will be coming from adding, and in H1, we have added around 18% new customers. So I think it will be a combination of the 10-12% customer addition, 10-12% increase in ticket size, renewals, because we have added a lot of customers in the last 5 years. So those renewals are coming in. The network, which we have built, around 500 branches have come in the last 3 to 4 years. They will start maturing. We also have an MSME book, which is now 4% of our overall book. That is also coming up very well. We ran a pilot for 3 years. Now we are very excited about that book. So I think it's a combination of all this will make sure that we are able to grow on a very sustainable basis.
Fair enough. Now let's understand the impact of fintech in your business. How is fintech going to be changing the business dynamics, the business which you represent?
Yeah. Nikunj, good point. So Nikunj, let me tell you that you are absolutely right. 5-6 years back, there was definitely a talk that look, fintech will disrupt. Fintech will make sure that some of these old age banks or companies like us, which are more brick and mortar, will face a competition. But let me tell you very smartly here what a company like us have done. In the last 5-6 years, we have done huge investments on technology. Today, we are we are like a fintech company. The only difference, Nikunj, in our case is that we have feet on street, we have data, we have branches. If I can tell you that today, until 2016, all the disbursements were happening in cash because of this whole digital infrastructure which has been built up in India, Jandan, bank account, mobile, 100% we transfer money in the bank account. The second point I tell you, Nikunj, that our turnaround time for the customer was 15 to 16 days way back in 2015-16. It has come down to 4 days. It is paperless now. It's an assisted model through an app. Our field officer is able to onboard the customer. We are able to use technology to really bring a lot of economy of scale, handle scale, bring more control. So what I can tell you, and also one more thing, we are partnering with some of these fintech companies which are providing very key niche. They have some core capabilities which are like company like Karza Scan, people who help some of these important elements in the whole value chain. So I can tell you that company like us have our overall outlay in the IT has actually doubled in the last 3 years. So we have done a lot of catch up, Nikunj, to make sure that we remain agile and do a really good combination of both brick and mortar is a physical and technology, because it's a touch and tech model. So that's where we stand.
I also wanted to talk about, this new thing that RBI has sounded now caution on unsecured loans in the system. Microfinance, although income generating loans are largely unsecured in nature, do you see any downside risk to your asset quality in the near term or the future?
No, I think what it has done is I see it as a positive for microfinance because one, as I mentioned earlier, there were some platforms which were doing a lot of these unsecured loans. Second is that there are some companies, some digital platforms which are outside the regulatory radar without any client protection. They were also trying to do, and create a risk. So in my view, that I can give you simple and a very simple language. Suppose our customer's son or a daughter, through app takes a loan at a unsecured loan and at a high rate. It really creates risk at a household level. So in my view, by doing this, I think the whole focus where the RBI is actually pointing everyone to is that please focus more on doing productive, funding productive businesses where there is a cash flow. I think that is where in the microfinance also, if you see the last regulations which were changed in March 2022, the whole focus is on the FOI, which is fixed, obligation to income ratio, where they are telling the companies to even microfinance that look at the customer household level, cash flow. So it's in my view, this is a very good stance because everyone, we all have to for a long term, for a long term perspective, we all have to make sure that the customer is not over-indebted. There is no risk which builds up.
Good to have you on board. Thank you so much for taking time out. That's the view coming in from the management of Titagarh, talking about their business outlook as well. From Fusion Micro, pardon me, talking about their growth outlook, talking about expanding their overall base, saying that overall they are looking at 22 to 25% growth this year. All right, let's get a move on then and talk a little bit about the year that was, the competition in the food delivery space, and of course, what the loyalty program plans are. Rohit Kapoor is the CEO of Food Marketplace at Swiggy, now joining us. Thanks so much for taking time out and being with us. My eyes almost popped out at some of the interesting findings that you guys had for the year gone by. 207 pizzas in a single day in Jhansi. And I'm sure the trends have been pretty marvelous that you guys have touched upon. Anything that has really caught your eye? Anything you believe that will continue into 2024?
Being a Calcutta boy, what caught my eye was that in Durga Puja, Gulab Jamun trumped Rasgulla, right? That was a little surprising, honestly, like coming from Calcutta and grown up there.
Yeah.
I think if I may, 2-3 things are becoming very, very strong. One is there is a clear fusion of the modern and the traditional, right? So in small towns, we see hot dogs selling, for example, whereas samosas are right up there next to each other. And so many such examples. So India is traditional in food. There's a lot of joy in discovering what we have and also experimenting around the edges quite a bit. That's one. Second is the events are becoming bigger and bigger. So, and they're becoming more national in nature. So, example, Ganapati used to be very strong in Maharashtra and parts of, Karnataka, etc. But even we find modak selling in pretty much all cities, right, during Ganapati. Third, I think, is really the arrival of convenience as a way of life. And people are choosing to vote with their fingertips and choose convenience and preserve their time for what they really care about. And that's how we see ourselves. We are ultimately working for providing unparalleled convenience to our consumers, and that's what keeps us going.
I'm pretty addicted to Swiggy Instamart myself when I need something to arrive at home in the next 10 minutes or so. Yeah. So that's pretty interesting for sure. But also wanted to get in a perspective as well. There have been, some new features and new loyalty programs. There was Pocket Hero for the value-conscious customer. How is that performing? How has that been received? Will you extend it to some other cities too?
It's a recent launch. I think there is a wide spectrum of consumers. I think India is not one, and there are consumers who look for different features, different benefits. So this is for people who like food but value is important for them. And we launched it in Gurgaon, but now it's been scaled up to other cities as well. There are multiple initiatives. I think we keep listening to consumers, trying to figure out what they are looking for, and also sometimes inserting things which they may not be looking for, but we are excited about and we believe will be big in the future.
So tell me, what is it that you're working on? I'm a Swiggy loyalist myself, actually from Scootsie days, not just Swiggy days. But what is it? Any new innovation that you're looking at?
You don't expect me to say that on national television for sure.
Okay, I'll figure on the app very soon, I'm sure.
Yes. But let me tell you how we think about some of this. Like, I truly believe that our business changes as the society and the kitchens of India change, right? And what is the relationship with the kitchen? So I'm very curious personally on what's happening in the kitchen and grocery pantries of India all across different cities, and that leads to. Let me give you a simple example. The moment both individuals, assume a couple living together, and both start working, it just changes the dynamic of the kitchen and the relationship with food, time, and convenience in a very different way. So rather than just looking at features, we are very curious about what's happening in society and what can we sort of build on and provide. Again, we come back to a very simple point saying we wake up every day to make your life convenient, and are there more areas, more things we can do to make it convenient? Yeah.
In terms of a trend, there was a view that 2023 started a bit soft and then it picked up in the second half. That's the trend which we look at when we look at your peers and the industry experts that tell us. Was that your experience also, that 2023 started slow and then it picked up only in the second half?
We had a more consistent feeling about the business through the year, right? Especially in the first three quarters which have gone by so far. This is a business where there is of course, it's driven by two or three things. One is clearly what we do, what the macros are in terms of GDP per capita, what's happening to the consumption economy. Second is what we end up doing, how we innovate and how we are able to provide value. And third is there is a bit of seasonality in the business for sure. There is, it is driven if there's a IPL happening or events which are more organic in nature. But in general, what we are seeing and what I share is India seems to be celebrating events in a disproportionate way. I'll give you an example. Like Mother's Day or Father's Day was never this prominent in our calendars as events, right? But when we see volumes on those days, and not just from the Bangalores and Delhis of the world, but from all across India, like it is quite fascinating on how trends are changing. I don't think COVID disrupted trends a little bit in terms of just distortion in baseline. But even then, any common wisdom which says that January is fast or slow or something like that, I've at least for the last 1+ year I've been here, I've found myself sort of not things are changing all the time. So we had I think it's been a decent year. I think this is a category which has become while we are growing, we're very small in the world context and scheme of things, where the food market is, what is happening. I remain very curious about what's happening in the quarter and perform towards that. But I always remain very, very optimistic about the opportunities in consumption patterns and where the penetration levels are in India in this business.
One thing, Rohit, and this is a little bit business related. In October, you raised your platform fee on food delivery, right? By about almost 50% from 2 to 3 rupees. How's that been received, across the platform, both from customers as well as the restaurant partners as well? And how will it help improve the unit economics?
Well, you make 50% sound like dramatic because of 1 rupee actually. On a average base of an order which is north of 400 and typically. But look, the reality is that this is a pretty standard practice, and there is and consumers have voted with their feet on this. We have not seen any impact coming from the consumer side on volumes because of this. and we do test it. We don't do any of this and without testing properly. And I genuinely feel that indexing on only, let's say, what is the platform fee or what is the other charge, etc., is one part of the equation. Consumers care a lot about how we perform on service, right? And in my mind, I think when those parameters become better, we see a much better traction, because one is profitability per unit, but it's also volumes and how you can keep growing the same repeat customers and keep adding new to category customers. It's a minor thing. I think it's caught the attention in the media for sure, but I don't think consumers have really they've embraced it. I think they understand that to deliver a service of this nature, which is real time, fast. I can almost tell you that. Quick anecdote: my son actually lives in the US, and whenever I go there, he's studying. And one request he and his friends has is, why don't you guys launch Swiggy here? Because I think they're to build something which the consumers care about and value. So I'm sure they're willing to pay the right price for it.
Very, direct question. It's not a business related question, but it is a question which everybody is curious about. India currently has 2 food delivery platforms, and then you got smaller players who are trying to do D2D and B2C, to be very frank, 2 large players. Do you think that really would be the market dynamics for a long time to come? It's going to be 2 large players who will dominate the food delivery market for next 5 to 7 years, or you see disruption happening there?
Listen, I genuinely don't see the market that way, right? And if you look at overall what we are competing with is the kitchen. Can we provide convenience and free up your time to do other things which you care about a lot more, right? And it's we compete with pretty much takeaways in India. Like there's a large part of the business in India which is takeaway. People just order, pick up the stuff on their own and go, right? We've not been, I think just boxing ourselves into a sort of saying there are these 2 players, right? And that's the market, and that's how the world is going to be. Personally, I never believe that is the only frame to look at, because that's a very limiting frame. And I'm not giving you an answer because I can't give you a better answer on television. I genuinely think so, saying this is really a limiting way of looking at the industry. Again, I keep repeating to my teams that we are very, very small right now. If you look at what food, like I remember speaking to one of the entrepreneurs who started a samosa business, and she mentioned to me there are a few crore samosas sold in India every day, right? If I look at my platform today, we're not even scratching the surface there. So honestly, I'm not a crystal ball gazer saying how will market constructs look like and structure look like, but I know that consumer has tons of choices in India, and whenever we do well, we get rewarded by them preferring us for their choice, and when we don't in service terms, we get penalized for not living up to the expectations. That's the way we want to think about life, not in terms of saying there are X players or Y players, because that number keeps increasing and decreasing at different points in time as you look at even the last 15 years, for example.
Food delivery market, and in India we tend to draw China parallel to everything. X number of cars are being sold in China, India is headed there. X is the per capita income of China, India will move there. If I look at the Chinese food delivery market, the per capita, the size, everything is strikingly different from India. So are we headed there sooner than later?
I forget China. I think if you talk penetration levels and scale over a 10, 20 year period, I don't see why not, right? Simply because it goes back to, is it a way, it is becoming a way of life? Yes. Is food going to be relevant in our lives forever? Answer is yes. Is India's relationship with food is like in many other countries, so food is very integral part? Yes. Do people, as they become, as nations become more wealthier, do they value time and experiences as a factor? Yes. So whether we hit the same numbers as China or we are somewhere there, but directionally, I think so. I would tend to agree that those are good penetration benchmarks to look at.
Okay, sure thing. Just wanted to get in one quick view from you in terms of, I'm sure this is something as a platform that you face, delays in terms of order deliveries, technical glitches really. Of course, they are one-offs, but does that really ruffle feathers? How do you deal with it internally, if we could just understand better?
Oh, we get very, very distressed when it happens. Like I can honestly tell you, those are our worst moments. I don't think we obsess about anything more than an order gone bad. And we operate at scale, so a few things do happen. I think we do operate at very, very high levels of efficiency and reliability. I think, having said that, are we at all satisfied with even the small percentage which happens? Answer is heck no, right? I think, and one thing about Swiggy is, and this is something which I think Harsha and team have built from day one, is we are extremely consumer centric as a company. No, not every company says that, but I think like a something which is going wrong with the consumers will almost be an emergency meeting between us versus some other, let's say, business parameter being discussed. So yeah, we care about it. Because frankly, I feel very bad whenever I'm not able to, or our company is not able to deliver the promise that we made to the consumer. It's not a good feeling, and we want to minimize that to whatever extent is humanly possible. We wake up every day living to that mission.
Okay, it's your worst nightmare, but you guys deal with it, and of course, can't wait to interact with you next year and hopefully sooner, and find out, of course, what India has been chomping and binging away on.
Okay, thank you, and wish you all a very happy upcoming holiday season and New Year.
Yep. Merry Christmas, Happy New Year. Thanks so much for joining in.
Thank you.
All right, we'll take a very quick break then, right here on the show, with news that we're at 21,373. Come right back as we assess the chart busters and get you more corporate voices.